Hey, what's going on, everybody? It is Aaron Trevino here, and we have another wonderful guest. We have Ben from Spartan Investment Group. How you doing, Ben?
Doing well, Aaron. How are you?
I can't complain. It's been a great morning, and it's great to connect with you and have you on the show.
Thanks for having me.
Yeah, absolutely, Ben. So for those of us who aren't too familiar, would you introduce yourself, please?
Yeah, sure. Ben Lapidus, Chief Financial Officer of Spartan Investment Group and host of the Best Ever Conference. Spartan Investment Group develops and buys self-storage assets and RV park assets. And the Best Ever Conference is a community of 1,000 plus syndicators, real estate operators, passive investors who come together once a year to learn, network, and invest in commercial real estate and throw a party.
All right, absolutely. Yeah, it sounds like you have your hands in a few different parts of the industry, huh?
Yeah, I got a little bit going on.
Yeah, absolutely. So, I'm just curious, where are you, where are you mostly doing most of your business? Do you focus on any particular markets?
Yeah, we are proactively looking at 154 markets across 33 states. However, we have found a lot more success in Texas than anywhere else, as a lot of other investors have. So we've got assets in Washington State, Colorado State, Texas State, Arkansas, and Georgia right now. But we are actively looking everywhere. We've got offers out on 12 different states at the moment.
Okay, absolutely. I'm just curious, more about you. How did you get into this line of work?
Sure. So when I was in school, I was going to be an investment banker, 2009. Terrible time to make that decision. And so I was able to squeak out an internship even after everything had closed out with Barclays Capital. Even though nobody else was hiring, Barclays Capital just bought Lehman Brothers fixed income business. They had the best fixed income business on the street. And that was a terrible experience for me. So I quit my career path and pulled an audible. I moved to Costa Rica and built a study abroad company for 3 years. So my first year out of college was the third year that we were in business, and we were doing about 500 kids a year at $4 grand a pop, so about 2 million in revenue. I had a falling out with my business partners, sold out my stake, and took the proceeds and bought into a couple of single family residences in 2012. Which got me into real estate. I got a job in New York for a company that 9 months later IPO'd, made a bunch of young VPs a lot of money. And they heard that this kid was making a 20% cash on cash return with B grade assets and B grade cities. So they started throwing a whole bunch of money at me. By the time I was 25, I'd accidentally syndicated over $1 million. I had over 50 units in my portfolio, and decided that it was something I wanted to do full time. I moved to Denver for my wife and didn't know anybody. So I started the Best Ever Conference, which was to bring commercial real estate syndicators together. And in the process of doing that, I met my now business partners, Scott Lewis and Ryan Gibson. And we formed this iteration of Spartan Investment Group and focused our attention on the self-storage assets. So I sold off as much as I could on the residential side. I've got about a dozen units left, but all of our attention is now focused on building a great place to work, a commercial real estate syndication and development company. We now have over 35 people that work for us, over closing in on 200 million assets under management, and an awesome investor network. And we're just getting started. We were ranked number 8 fastest growing real estate company by Inc. 5000 last year, number 308 overall. And I think this year will be even better.
Yeah, absolutely. Well said, Ben. It's, to many on its face, it seems like a very unconventional path into the industry. I'm curious, maybe when you were growing up, did you even have your eye on real estate, or were you just not really interested in this line of work before?
I had my eye on entrepreneurship, not necessarily real estate. I never thought I would get like a real estate license, and I don't have a real estate license, but I never directed my attention there. It was either be a big Wall Street guy or build a company, probably in tech. Neither of those were necessarily things I was all that great at. So being in real estate definitely allows me to exercise my superpowers and my passions. And it's also something that I'm decently good at.
Yeah, no, you touched on something interesting there. Kind of, you're making it sound kind of like a self-awareness, right? Just kind of knowing where your strengths lie.
Yeah. I think, a decade ago, everything looked exciting. I was like a dog chasing squirrel, shiny object syndrome to the max. But I read something in Eric Ries's Lean Startup Machine about how to choose a business that you work on. And I think it's the exact same advice one should give for a career, not just a startup business. And that was find something that is at the intersection of what you're the best at, what you enjoy doing, and what you can make money with. If you only have 2 out of the 3, it might seem like a good way to spend your time, but it's not the perfect way to spend your time. And I spent the better part of a decade figuring that out.
Yeah, absolutely. I guess that's kind of the value in, paying for a book, or, even paying for being part of a conference, or getting some sort of information where, someone else can go before you and kind of, give you those pointers.
Yeah.
Yeah, absolutely. So it kind of sounds like maybe your different work experiences over time kind of got you to this point, or was there any sort of aha moment when you said, hey, this is the line of work for me?
I think that I realized I really enjoy negotiating and acquiring assets. I went to school for finance. It's something I feel gifted at, is mathematical intuition and business common sense. However, I am not very sound operator. I'm not the most organized. I'm not the most disciplined in vendor management. So finding business partners to complement me so that I could focus on my shiny object syndrome, which is find the next deal, find the next deal, find the next deal. Make sure that we can operate it according to our business plan, suss it out, go through the 600 plus due diligence point checklist, do everything that we can to button it up, but then hand it off to a team that can do a much better job at managing the construction and managing the operations that I can. So I think realizing that I have things that I'm very strong at and things that I'm not so strong at, and plugging those holes with business partners and people that I can trust was the aha moment. And then it just took a long time to figure out exactly what that looked like.
Yeah, no, well said, Ben. Now, I'm just curious as well. You brought up something as well, kind of talking about, your operation, your team, right? So it kind of sounds like you like being on the hunt. You like looking for those deals, bringing people together, whereas you tend to not like to do the operations. What other parts of your team, what other roles do your team members play?
Yeah, so our company breaks down into the following functions. There is corporate finance, which is your kind of your backbone, bean counting, accounting, which I'm good at managing, not so much good at executing on it, but decent at building the infrastructure and managing that. Then there's the acquisitions and asset management, buying assets as well as making sure the portfolio performs. Consider those to be 2 separate things. And property management, which is very different than asset management. So, the nitty gritty, the minutia of being on site and managing repairs and lease signatures and lock cutting. There's construction management, whether that's estimating or managing the project or being a field engineer or just being in charge of the whole function. And there's investor relations. So the investor relations for us is both equity and debt. We raise a lot of our capital stack privately. And so the investor relations function just manages the administration and the relationships of investors. And finally, there's strategy. There's making sure that everybody has a vision and a set of values and a story they tell themselves to be part of an organization that makes them feel like they're in that family. They have a sense of purpose. And part of the strategy is people development, team building, and coming up with a plan for everyone to rally around over the next 3 months, 1 year, 3 years, 10 years.
Yeah,
So that's kind of how our organization breaks down.
yeah, absolutely. Well said, Ben. Again, it kind of comes down to, like you said, kind of that self-awareness, understanding where your strengths lie, and then, kind of building a team around, that, like you said, that common mission.
Yeah. How about yourself, Aaron? What do you do in real estate?
Yeah, absolutely. So I live in Austin, Texas, and I work for a construction lender. So I'm an account manager, so I'm kind of the client-facing guy. I speak directly with the investors, the builders, the developers, and we finance their projects.
Awesome. And is that your long-term ambition? Is this show to support that business, or is this show to support something larger?
Yeah, absolutely. Definitely to support the business. I do foresee myself, working in some capacity of real estate and construction as well. Whatever that may be in the future. But I definitely do enjoy it. I live in Austin, so I'm able to, it's nice because it's centrally located. I can meet with different clients, Dallas, Fort Worth, Houston, San Antonio. And it's been great, and we help people with their flips, their new construction. We'll do ground up construction of multifamily apartment complexes, different things like that.
Great, great. Cool.
Yeah,
Good for you.
yeah, absolutely. So I guess, kind of see a bit of overlap
Yeah,
in a way.
for sure.
But,
For sure.
but yeah, it's always great to chat real estate whenever I can. But so I'm curious about you as well. You mentioned how your wife was in Denver. You had kind of been out and about. You found your way back to Denver. From that point, was that when you started Spartan Investment Group, or what happened from there once you got to Denver?
Sure. So Spartan Investment Group was officially formed in 2013 by Scott while he was in Washington, D.C. for the purposes of buying brownstones, doing pop outs and dig outs and converting them into condos and selling off one condo at a time. And that was lucrative. They did about a half dozen deals that way until about 2015, 2016 when the margins got squeezed. Scott moved out to Denver. Ryan moved out to Seattle. I simultaneously moved out to Denver with my cash flowing portfolio. Realized that I didn't really have any quality flipping experience, wealth building experience, and they didn't have any cash flow management experience, any income producing experience. So it was a good marriage of skill sets. So we leveraged the company that was already in existence, Spartan Investment Group, for the purposes of doing pop outs and dig outs of DC brownstones, and just shifted completely the business model to self-storage in 2016. And the way we did that was A, we found each other, and B, we went through an evaluation process for 90 days where we scanned the operating environment and came up with evaluation criteria of what is, again, not just for myself, but as an organization, what can we make money at? What are we what can we become the best at if we're not already the best? And what will we enjoy doing on a regular basis? And so the evaluation criteria that we came up with after that sprint was easy to manage, easy to monetize, easy to maintain. Easy to maintain meaning there's not a lot of below the ground risk. You don't have a bunch of toilets with sewerage pipes. Easy to manage meaning this isn't people's livelihoods. They're not coming and going and living in this place. There's not a bunch of wear and tear. And then easy to monetize. The eviction laws on self-storage are a bit more favorable than for multifamily, just because again, it's not people's livelihood. So if somebody's not paying, you can turn that unit around fairly quickly without a lot of litigious risk. And monetize it again. So we liked those aspects. RV parks is close to that. It's a little bit more difficult to manage, especially on the high end spectrum. But we liked those aspects of self-storage, and then we learned everything that we could about it. When we go into something new, we buy every book on Amazon, read it, go to every conference we can, interview as many people as possible, go to masterminds or whatever, and have hubris. Know that we're still going to make mistakes and underwrite for those mistakes.
Yeah, absolutely, Ben. It's at least kind of the common misconception about real estate is when you hear the words real estate, you think, buying or selling a home, or if you think about being a landlord, you think about the clogged toilet at 3 o'clock in the morning that you get a call about. But it seems like with your line of work, that's not even in the equation.
No. Well, I mean, it is. There's definitely the equivalent of that in self-storage. But for me in particular, the benefit of constructing a team is that you can focus on the things that you're great at and you can allow the rest to be taken care of by others.
Yeah, absolutely. So, can you kind of run us through, in terms of self-storage? I mean, are there any particular areas you're looking at? Maybe are you looking to be, in a really dense urban area? Are you looking to be in the outskirts of a city, or where are your where most of your property is located?
Yeah, so we for the most part focus on secondary and tertiary locations. We like low REIT competition when that's possible, and we like to be near enough to population centers that we can ensure that any expansions that we do will be filled up by the existing demand. So we have our internal formulas that we use for determining if there is going to be a glutton of supply relative to the demand that's already in existence, so that if and when we expand or do our ground up development, we'll know that we can lease that up. But it's very intersection specific. Self-storage, it's a convenience retail essentially operation. So you could be in the right town in the wrong intersection. You could be in the wrong intersection in the right town. So.
Yeah, I was about to kind of follow up with that as well. It seems like, with that being said, there's an extensive amount of due diligence and homework that you have to do when you're looking for those
Yeah,
properties.
there sure is. There sure is. Yeah. It's not like doing a single family. In a single family, you kind of do your inspection, you get an appraisal, do title, more or less done. We have like I mentioned earlier, a 600 plus point due diligence checklist that we go through, and a 100 plus point feasibility checklist that we go through.
Yeah, absolutely. And I'm curious as well. I know you kind of mentioned how, maybe the birth of the company, the different skill sets you have. I mean, does that happen over time? You getting to that many points? It seems like that's a pretty extensive process.
Well, sure. Yeah. Yeah. You learn something new. You have a new experience. You close on 30 of these deals, and each time something new challenges you, and you make sure that you don't get challenged by that again in the future.
Yeah, yeah, absolutely. So, are there any other particular, I know you mentioned the secondary, tertiary markets. Are there any things, maybe someone's just starting out, they're looking into self-storage. How would you suggest someone even do their due diligence?
Well, so let's define due diligence versus feasibility, right? So in my head, due diligence is verifying what the seller has indicated as true to be true. Feasibility is assessing the operating environment and making sure that everything outside the seller's control or outside the buyer's control is a set of conditions that are going to lead to your success. So to me, due diligence happens after you go under contract, and all you're doing is you're verifying that everything that was offered as a material fact is true. You're not necessarily assessing whether or not your business plan is feasible. So I think that the feasibility component is the thing to concentrate on when you're first starting out, because you want to make sure that you can execute your business plan and that the market isn't going to just rip you a new one. Due diligence is mostly just checking through bank statements and surveys and title work to make sure that I can buy this thing and it does produce the income that it was marketed to me as, and it's not going to fall apart tomorrow. That's due diligence, right? So in terms of just starting out for feasibility, it's tough. I mean, real estate in general has become incredibly competitive. It's not like a decade ago where you could buy anything and make money if you held on to it long enough. You have to really understand your asset class, and especially in storage, things are intersection specific. So if you get your demand numbers off, or your supply numbers off, or your rent assumptions off, if you're too aggressive on your rent assumptions, you could be giving the project back to the bank. So the good thing with self-storage is that cap rates are compressing. And so a lot of people are being bailed out of bad investments by compressing cap rates. That has nothing to do with their ability as a real estate investor. But you shouldn't bet on that in the future, even though it is likely to occur. So I would highly recommend going and checking out an educator in self-storage like Scott Myers, who has a mastermind group and an educational platform, or Mark Helms, or going to the storage industries. I would look at 500 at least offering memorandums by the 20 plus brokers that are top notch in self-storage nationwide, and use them as a benchmark when you're looking at game theory. You're playing baseball, and you don't want to swing at the first pitch, right? So to me, the first pitch in buying a new commercial asset is evaluating 500 properties before you make an offer on any of them, just so that you can generate yourself a benchmark.
Yeah, absolutely, Ben. That was a great explanation you had, kind of explaining the distinction between feasibility versus due diligence. And you brought up something very interesting as well. You used the words game theory. And I know you just briefly touched on it, but could you kind of elaborate on what game theory is and kind of what it means in this sort of context?
Yeah, so game theory is a subset study of economics that creates an imperfect world. And by an imperfect world, I mean something that resembles real life, but doesn't have all the conditions of real life, doesn't have all the chaos and nuance of real life. It is it's like real life with bumpers on the bowling lane. And then you create a game and you see what the outcome is going to be based off of a certain distribution of probabilities to determine what is the optimal path forward. So it's the mental thought experiment of how should I take my next step? And so there's a great paper, and I can't remember the name of it, but it was interestingly written as a thesis by a Stanford student who is the son of a Japanese prime minister several decades ago, that talked about arranged marriages, specifically in Japan. And the game was, again, not real life, but it meant to mirror real life. The game was, if you have 10 women or men, if you're the woman in this scenario, but 10 women or men, that you are in an being set up for an arranged marriage, and you can see one at a time, but you can only see each one at a time. And once you say no to one, you can never go back, but that's the only way you can see the next one. So the first person enters, you have the opportunity to decide, do I want to marry this person or not? What is the optimal approach to this game where you have up to 10 men or women that you can select, but you can only see one after the other if you said no to the previous one? Well, the best way to go through this game with you do this game 1,000 times. What has the highest probability of the best outcome? The highest probability of the best outcome is to take 3 of these people and to say no to them no matter what, regardless of how exciting they may be or how terrible they might be a fit for you. You say no matter what, and that is your established benchmark. Bit of a kind of old school game that we're talking about here, not necessarily politically correct, but I'm referencing a thesis paper for the constructs of game theory. So after those first 3, you only say yes if you have excelled past the benchmark that was set by those first 3. And now, again, you have to play this game 1,000 times to have the probability distributions to work in your favor. Yes, the next 7 could all be worse than one of those first 3. You could lose. Or one of those first 3 could have been the right choice, and you could lose and not have the optimal outcome. But without knowing those conditions, the best way to produce the best outcome is to follow that game. It's kind of like counting your cards with blackjack, right? Like you keep yourself to a set of specific rules, and you give yourself the best probability of success. You're not guaranteed to walk away with more money than you started with, but you're giving yourself the best probability distribution, right? So it's the same thing when assessing real estate deals. You want to establish a benchmark. You want to have an investment theory that's based off of that benchmark, and you only want to do deals that's within the subset of that investment theory. You don't want to be bending your criteria unless you've assessed your environment, your operating environment, and you've established a new benchmark from it.
Yeah, that was a wonderful explanation, Ben. Just kind of explain it. Basically, it's kind of just putting yourself in a position to win.
Pretty much, yeah. Or more importantly, it's putting yourself in a position not to lose, because it's a lot easier to lose money in real estate than it is in investing in general than it is to make money.
Yeah, no, I like that distinction you have between winning and yeah, absolutely. Yeah. Sure. And I know you mentioned, maybe for someone starting out, kind of getting their feet wet in the industry, kind of getting connected to people like Scott, like you mentioned as well. What other resources do you think people could use, or, could you kind of explain what your conference is?
Yeah. So I think, there's a whole bunch of data in real estate, and there's lots of ways to win, but it's still very much a relationship business. And learning how to syndicate your own capital is a very flexible way to scale drastically without institutional backing. And that also requires relationships scaled to the thousands. So building those relationships requires quality interactions. And so we built the best ever conference to accommodate those quality interactions, and something that is beyond what you would get out of a local RIA, real estate investment association. So this is a national forum where diversity of thought is brought onto stage, anywhere from 40 to 60 speakers each year. Nobody talks about the one way to skin a cat with $100,000, cost package to peel back the magic curtain. There's value in that for some people, but that doesn't happen at our conference. There's nothing being sold. We have nothing to sell. It's a trade event. Once you bought a ticket, that's what we have to sell to you. So you show up and you're really just there to learn and invest in network. We have no secondary motives. And by bringing 1,000 people together, and by making sure the content is intermediate to advanced, and by having a higher ticket price, we have artificially reduced down our audience base to be those of very high quality, so that when you're showing up, you are colliding with and bouncing off of people that can either fund your deal or give you a place to place your capital, or teach you something new, and you can teach them something new, or find a new business partner. At least a dozen companies that I know of have been formed out of this conference, including mine, as a result of people meeting each other.
Yeah.
Yeah, I highly recommend in-person interactions.
Yeah, absolutely, Ben. There's a lot to be said. Kind of what you spoke about was, when there's a barrier to entry, it kind of ups everyone's game to an extent.
Yeah, yeah, on average at least. Yeah.
Yeah, no, absolutely. And I know you mentioned the word syndicating, and you kind of work in that realm as well. Could you kind of explain what syndicating is and what it means in this context?
Yeah, syndication just means aggregation, accumulation, right? It's piecemealing things together and taking multiple disparate parts, putting them together, and saying this is now being used for one thing. You wouldn't use the word to say assembling a car. You would say assembling a car, but you wouldn't say assembling capital for the purpose of deploying it into a commercial real estate asset. You'd use the term syndicating capital. It's kind of like when you hear syndicate in content, when a syndicate conglomerate media company buys a bunch of local news channels, they have syndicated that content into a single consciousness, a single message that's being sent to the American people. So same thing, you're syndicating capital, you are accumulating capital from different sources that are all separate. They're not related to each other, but you are putting them into a vehicle, a special purpose vehicle that's deployed for a singular purpose. You're syndicating the capital and deploying it into one asset. So that's what we do. That's how we capitalize our assets. We have thousands of investors on our database. A significant percentage of them are activated and they engage with us and place capital. And we raise that money under something called Regulation D, which is a set of exemption code that the Securities and Exchange Commission has. We use 506B and 506C exemptions under Regulation D. So there's a ton of free content out there. There's dozens of attorneys that share that information for free. So I'll just leave it there and say we leverage 506C, 506B under Regulation D to syndicate our capital.
Yeah, yeah, absolutely. So, when you're talking about syndicating capital, are you speaking mostly, you're dealing strictly with self-storage, or do you do any other sort of deals?
Yeah, we own a couple of RV parks, like I mentioned, and that is something that we're going to be investing in more proactively in the future. We have done some other stuff. We bought a car wash that conveyed with the self-storage asset that we bought, and we have done a joint venture, are in the process of doing a joint venture, almost done constructing it, building a 217 pad mobile home park in Washington State, which is a pretty cool project. It's a Class A mobile home park, very high demand, very tough to get those built these days. So we're opportunistic people. We don't consider ourselves storage people. We don't even consider ourselves real estate people. We consider ourselves quality business people, people who invest in businesses that just so happen to be focused at the moment on real estate because it's a great risk-adjusted return. It's a good hedge. And at the moment focused specifically on storage because of the evaluation criteria within the real estate subset.
Yeah, absolutely, Ben. And I know you kind of, that was a great explanation. And I know you kind of mentioned earlier a bit about RV parks, maybe a bit of the challenges, with those RV parks. Could you kind of maybe explain maybe the challenges of working on an RV park versus working with self-storage?
Sure. Well, I mean, there's just more management to it, right? You need one manager for 100,000 square foot facility sometimes to process 1,000 clients, maybe one and a half. When you have an RV park, you need an office manager, you need maintenance, you need, depending on your amenities, people to cater to the amenities. If you have a restaurant, a pool, groundskeepers, it's just more staff to manage. So whereas you can get away with anywhere from like half a person to 1.5 people at a storage facility, you might have 5, 10, 50 people at an RV park, depending on the degree of complexity to your asset. That's on the operations side. On the acquisition side, there is no collateral. An RV park is just a dirt patch with some amenities. I mean, if you have like an office or a pool or whatever, but a lot of RV parks don't even have those things. It's just dirt with utility plugs, meaning you've got electric and sewerage just coming out of the dirt, and that's it. There's no structure. So from a lendability standpoint, there's not as much collateral. In fact, there's almost no collateral for a bank to say, if you don't pay me, I have something to take back from you. So the lending environment just isn't attractive, which makes interest rates higher, which makes cap rates higher, which makes the opportunity more desirable, but at the same time, more difficult if you don't have access to capital.
Yeah, absolutely. I can kind of see the quagmire with that. It kind of cuts both ways, I guess, right?
Yeah, yeah.
Yeah, absolutely, Ben. Well, is there anything you haven't said that you'd really just like to hit home for us?
If you're going to do real estate, do it with good people, find good team members, and have good values. I don't know. Yeah. I'll summarize it there.
Yeah, no, that's very well said, Ben. Maybe someone's listening, maybe they're maybe they're also in the same space, maybe they're looking to collaborate, they're wanting to talk about syndication, self-storage, maybe something with RVs, or they just want to get in touch with you personally. Where can we find you?
Yeah, you can check us out at besteverconference.com, or my email is ben@besteverconference.com.
All right, Ben, well said. It's been great. I've learned a heck of a lot, about, your background, between you being in Costa Rica to coming back to settling in Denver to syndicating, self-storage. It's been great chatting with you, and thanks for coming on the show.
Thanks for having me, Aaron.
Talk later.